Hello, welcome back to smarthelping.com. I've got an exciting manufacturing model here. At first, I was going to do something for 3D printing manufacturing, like the people who build 3D printers and sell them to other people who use the 3D printers. Then I realized, you know what, all the logic I'm doing makes sense for just a general manufacturing model, no matter what you're producing. Could be 3D printers, it could be valves, any kind of widget, whatever products, just any manufacturer that's going to produce things. Uh, and it's more advanced than just a model where you're sending stuff overseas to China and then getting it back over. This is like you have the plant, you own the plant, the buildings, the whole manufacturing process, and it does have logic if you want to, like, and you could be renting the plant and factory and everything. You don't have to actually buy it, but this is assuming that you have control over the manufacturing building itself and all the equipment within it. And so, yeah, it gets pretty complex because you have cost of goods sold, which in manufacturing you have to take into account depreciation as well as all the direct labor and the overhead items that can be directly applied to producing your widgets. So this is I've never done this type of model completely, and I've done some manufacturing stuff, cost per unit stuff in the past that was very simplified. This model here gets into depth. It goes out for 10 years, monthly and annual basis. It's got all of the bells and whistles that I can think of, and just wait till you see as we get into it. So what I'll do is go through each tab, and then I will explain all the assumptions, how it builds up, and how it goes through the whole model. So first off, we have the date. So this sets the date of the entire model. You always want to make this date the first month of the year production is starting. So even if I'm starting in January or June of 2020, I want to make this January 2020. So you've got your basically your settings for the timing. Then you have an exit month, which is gonna you can have NA if you don't want to plan an exit, or you can do any month within the 10 years, and that will stop all operations. It'll give you some exit multiple based on EBIT, which in manufacturing earnings before interest and taxes is the main metric because depreciation is such a big part of your costs that EBITDA is not really as important as EBIT. So this multiple is based on your earnings before interest and taxes. So some multiple of that. You can have the option to also sell whatever depreciable value is left of your fixed assets at the sale. You hit yes or no on that one. And then you have an exit value. This is just the exit value of the EBIT multiple, not including the fixed asset, but you'll see in the summaries all of the stuff is shown line by line. Uh, so that's kind of your settings, your exit possibility. For the exit, there's also a building assumption. So if you're leasing the building, it wouldn't matter. You just put on your fixed expenses, you've got some kind of building rent. But if you're buying the building, you have the initial cost here, useful life, the monthly depreciation, which this is assuming only the building plant that's allocated directly to the production of your widgets. If you are also have to buy an office building or rent an office building, those costs would not be included here. Um, because they're not going to account for producing your actual um, your widgets. If you were to buy like an office building separately, that'd go under other startup costs, and then you'd have to fill in. I did a second depreciation line that's is for anything that's not related to production, which you can just manually fill in here, because that those situations vary so much that I just wanted to make a slot for it if you need to account for it, but if not, it's okay. So that's your startup. Then you've got cash sources. So obviously you need to buy stuff to start your business. You have to invest some money up front. So this shows you how much of that's going to be debt, like through a traditional principal and interest loan, and then how much remaining cash is going to be required after that, which is typically going to be equity from either the owner or sponsor or investors. And based on that, you can then drill it down into how much is coming from investors, what percentage of the company they're getting for that investment, and then the remaining filler is going to be your remaining equity needed. And this is driven based on all the monthly cash flows, positive and negative. The minimum, uh, the it basically adds it up and takes the lowest number, and that's how much equity you need. So that's how we're getting this top number up here, and that's how we automatically fill the remaining equity needed by the owner operator after accounting for investors. If you just put a zero here, then that's just going to be the same as the total equity up here. Then you got debt and equity percentage. You get corporate income taxes here, which we can calculate since we're going to know depreciation, interest, and all that. We can do earnings before taxes, which is a row, and then figure out what our taxes are. You've got, these are just some helper calculations I use elsewhere in the model, but the exit year and the month that the exit happened, this can also be important for knowing how much taxes were paid. All right, now let's get into the fun stuff. So unit cost and production. So this model gives you the ability to plan out 10 different types of widgets, and they might start at different periods in time, or they might all start at the beginning. But I didn't want to do just one type and just have you do average, have the user do averages for everything because that's not as helpful. Splitting it out into 10 different types gives you flexibility for accounting for things that might cost more, might cost less, might take up more or less equipment pieces. So all that's accounted for in here. So you name the type here, and this is going to flow through the model. You pick the month that it starts in production, and then we then need to figure out all of these different costs for production. So, well, first let's look at the logic for max units produced. That's going to be based on the equipment you've set up to use for this and the max labor usage you have here. What is the absolute maximum amount of units you can produce per day for each of these types? And then based on operating days per year, and you get a max units produced per year, and then obviously to figure out how much revenue you're going to make, you have to have a sales price per unit, which you're going to want to check that against your actual cost per unit, which we'll get into. So you have max, and then we're also capacity here is going to define of that max how much is actually getting produced each year. So you might not start with your max production uh, in year one. You might start with some percentage lower than that. You also have annual labor. So this is going to try to figure out, based on producing this maximum, how many laborers do you need, and how many hours are they putting in per day to get that production, and what's their average hourly rate for this. And this is all for this one type of widget you're producing. You could change the variables for every single different type. And that's going to give you your annual labor cost, which the main thing we're actually using here is the average labor cost per unit calculated in this cell. But keep in mind, these labor costs are also all going to be reduced by whatever percentage of capacity, because you may produce less, and if you are, that's likely going to mean you don't need as many people working on it if you're producing less. So this just applies the same percentage to both of these variables to get your actual units produced and direct labor costs. Um, then we have materials. So this is like, if you're producing a 3D printer, you need probably some metal, some plastic, uh, all kinds of fasteners, just anything you need to put whatever you're making together or to actually produce it would go here. And you could change that for each type, and that gives you a total material cost needed per unit. And that's going to drive our raw materials which will be purchased ahead of time. So there's also a variable for like how many months ahead of time you're going to buy your raw materials, and that will all go through the cash flow, and that like the monthly amount, which is attributed to how many units produced, is going to account for your gross profit. But then when you actually figure out cash flow, that'll get added back in, and then you reduce out the actual purchase whenever the purchase is made. Okay, so that's all of unit cost per reduction. Now, one thing to keep in mind is I've done this equipment purchase schedule. So this is supposed to line up with when your units come online or when you start producing them. So I put like the start month that each type of widget you're producing starts up here. And that needs to correspond with this month in service of equipment. So what that means is, and this is for stuff you're buying with depreciation, if you have equipment that you're just renting, that would go under just like if you're renting your factory that you're producing things, and that would go under the top section of the fixed expenses. You can pick the month it starts and the monthly cost of that in each of the years in the future. Now, anything here is just going to evenly distribute over what widgets are being produced at a given time. So, but I wanted to give the flexibility. I didn't want to put everything in here. I wanted to allow you to say, well, this equipment item I buy, let's say you buy 5 of them, cost 100,000 a unit, $500,000, got a useful life of 10 years. Let's say that's only going to be used, that's going to be evenly used for type 1, 2, and 3. So you need to make sure the month in service happens before the start month of production. Otherwise, you have a logical error and the depreciation won't make sense and everything else. So let's say we actually put this in service in April. So now we have an error. Well, how do you know there's an error? Well, look at here. I did a matrix that tells you if there's an error or not for every type for each different piece of equipment. There's like 80 slots here for equipment. So that's error, and that's right, there is an error. So you need to go back and say, oh, wait a second. This actually had to be purchased before the start month of the production of those widgets. So it could be January, February, or March, and it'll work. Um, but I put January for these, and these are all just fillers, assumptions. You'll fill out all of these things in light yellow based on whatever your actual assumptions are. Um, but I just put month of service in January, and I'm starting all these widgets, these first 3 in March. So you're going to have a little bit of a window, like between the time the cash goes out to buy it and the time you start producing stuff. It could be a month or 2 or 3 delay or however, but that's what is going to be accounted for based on the difference between your month and service date and the start month of the widget production. And then you can allocate a certain percentage of the depreciation of the equipment that goes to each group. And I thought this was going to be complicated, but when I actually started using it and actually thinking through it, it makes sense and it is very useful. So like these first 17 pieces of equipment, we're basically saying we have to buy all those up front. They're going to be used to produce type 1, 2, and 3, and this is their usage. Now, let's say in the future you buy some more equipment in order to start producing some other things. You can say, well, here I'm going to buy in July and start producing in August, and I'm going to do that for type 4 and 5 widget, and they're going to each split the cost of this equipment evenly. And you can do that again for another piece of equipment, and then you can say, well, now if it's 100% use, you can say, well, I'm going to buy this piece of equipment, 100% of it's going to go into producing this widget. Now, most cases, if it's an assembly line or something, you'll probably have an even split for all the widgets. So it just depends on what you're manufacturing, but this gives you enough variability to actually get some accurate numbers for your cost per unit allocations. Um, 1 second. Oh, I thought I was going to sneeze. Okay, so we got that out of the way. This is probably one of the most complex parts of the model, but definitely necessary to figure out a true cost per unit of production. Next up, so we talked about capacity growth, equipment, building, your other startup costs. are here. This is like if you want reserves or you build a website or have some one-time fees, whatever the case may be, these are costs that happen in year zero. And then you could type in here a one if this actually is a deductible thing and not a like something depreciated. And if you put a one in here, it will automatically show up in the first month of the forecast and reduce off of your taxable income. So you can see this, we only have 40,000 coming through. That is right there. And that's just based on this number here. We put a 1 against these two. So we're saying we want to deduct these off of our taxable income, but you might not have all these one-time startup costs might not be deductible. They might be depreciated. And if they're non direct unit producing items, then you would depreciate them here and the cost would go in the startup cost. And then and then that wouldn't affect the cash flow. Would just assume cash goes out here, but it's not going to look at the depreciation because it's a non-cash item. Uh, okay, then the last assumption tab is your fixed expenses, and this is just so we talked about the top section here is all for um, things that are directly related to the cost of producing units. You also have other things like your CEO, finance manager, office stuff. This is not direct, and you don't want to double count anything, so make sure you're not accounting for things twice. But these would be any items you're not including for the cost of production, which you wouldn't include the CEO, CFO, and manager. You might include a plant manager in up here, but that's probably about it as far as personnel goes. Um, and then obviously you've got all your direct labor that's already accounted for. So here you just pick the month that the cost starts and what the monthly cost is, and there's about what 32 slots there. Now if it's a salary item, you are going to have payroll taxes and benefits, so you can just put a one next to any item here that needs to have that accounted for, and it will flow through the model. And then at the bottom here, you can define what you think the payroll taxes and benefits percentage would be based on salaries or wages. This also will apply to the direct labor that's happening here for these workers. So we have this for G&A, R&D, same thing, and sales and marketing, same thing here. Then you've got percentage waste. So this assumes maybe you don't sell all the units you produce, and because of that, it's going to cost you some of your revenue. So whatever percentage you put in here will flow through to waste, which happens in this row here. And that's basically saying, well, I sold everything I made, but actually, no, I'm not. So you got to take out what you think you're not going to actually sell. That just gets wasted, which could be some small percentage. I'm sorry, that's in this row, units wasted. This is your payroll and taxes for everything outside of direct labor. You can see direct labor, payroll, and taxes is happening right here. And then now let's get into another fun part. So the monthly detail. So here we have all the metrics, and this is how we're going to derive our EBITDA and EBIT, as well as monthly cash flow. So you've got every different type of widget. You've got your production per month over time. This all goes out for 10 years, and it changes based on your assumptions entered on all the tabs we just went over. So you've got each unit type. You've got the revenue per unit. You've got the direct labor cost allocated per unit, which is all derived from each of these assumptions. You've got payroll taxes and benefits per type, and this is not double counted. So this total here is always going to match this total, and we have to split it out so we can get accurate cost per unit. But don't worry, it's not being double counted. You've got direct material costs per type. You've got indirect overhead per unit. So this is going to be all of these things here. These costs split evenly between each unit that is in existence. You've got depreciation per unit. which is going to come from our depreciation schedule over here. So here you can see the depreciation that's happening on each equipment piece, and then that gets applied right here based on the percentages you put on the equipment schedule here. So it's summing up basically all the depreciation times the percentage for each unit. On this. And it's just using a sum product to multiply basically all of this evenly times your equipment rental percentages here. And then it just goes over, so it goes L, M, N, it's going over, but it's actually going down in the matrix. So you can see this is summing up L, M, N, O, P, Q. You can see it changing up here. Then we have a depreciated value of assets. So this is just to figure out if you're going to sell, what the total value of all your assets is based on depreciation that's happened. This is also a checker just to make sure if you don't do the assumptions right, you could have it that your total depreciation is not allocated to your total categories, and that could happen if you do some of the things we talked about earlier where you put the dates in a way that's not logically feasible. And so that's depreciation per unit. And then we also have the depreciation from the plant building, which is separate because I had to include it over here as its own assumption, but that's accounted for. Here's indirect cost overhead, which is not double counted again, but it's just there for reference. Then we've got our total cost of goods sold, the gross profit, which this gross profit is really important for manufacturing because that's basically all how you're making money and how you're allocating your costs per your revenues. Now this I highlighted in light green because it's one of the most important parts. You've got the average cost per unit. So what this does, it adds up every single depreciation from the building, depreciation per unit from equipment, from indirect overhead, from direct materials, payroll taxes, direct labor, and then it's taking all of that divided by how many units you produce for the month. And based on that, you get a cost per unit. And that's probably going to help you set what you think you can sell the unit for. So whatever margin you want to make, if you want to make 50% margin, you're going to have to charge double what the cost is. But this is a really good way to see all the logic and the math laid out and really think about what you might be able to charge for your widgets when you sell them. Okay, so next up, we get to our fixed expenses, G&A, R&D, sales and marketing. Now, if you see, we've got the indirect overhead up here. So this is all of this top part. So it's accounted for up there, up here. And it's not double counted, don't worry. When we see our gross profit here, you see this is not counted, but that 432,000 is actually going to be accounted for in the total cost of goods sold. So you can see it's added right here for indirect overhead. And then also the direct labor, you can see this is adding up the total here. It's not double counting that payroll and benefits here, which is the same as this row. So it's very important here that you're not double counting anything or else your numbers are going to be completely off. So then after you count for all of that, your wage, taxes, you get an EBITDA, which is just cash flow. So it's not including depreciation, and then you can put in any depreciation that you have that's outside of the equipment production and plant. You got your startup costs, then you have EBIT, which is very important. We're at earnings before interest and taxes. We derive that from EBITDA, and then we're adding back the depreciation items up at the top. all the way up here. Depreciation item, and reducing any other depreciation that we haven't already seen. And now you got EBIT, and then to get to your taxable amount, we're just reducing the interest off of here, not the principal, and then we have earnings before tax, then we do a tax rate on that number, and we get net earnings after taxes. Then we have other cash flow items, so you've got like the fund, the debt, the money you got from the bank or whoever you're borrowing money from. You've got repayment of that debt upon exit. It automatically assumes whatever balance is left at exit is paid off. You've got the purchase of the building. You've got the exit value, if applicable, the building sale, the fixed asset sales, if applicable, purchased equipment. So here you can define, now I actually didn't go over this. So on the fixed expenses, you can define how many months you want to buy ahead for direct materials or for raw materials. So here I put 3, and then there's a matrix, some logic here to figure out how much you need to purchase each month based on that. And it's just looking at the next 3 months of raw materials, and it's saying you're going to purchase those in, ahead of time. So here's those purchases happening. Then you've got your equipment, which is just being bought based on your equipment schedule here, based on the date it's put in service. One-time startup costs, and then you've got your equity funding. So then we get cash flow here, and then this we have to account for all of this. We have to use EBITDA. This is when EBITDA comes into play because we want to know how much cash you have when you add back in the depreciation that was taken out up top, and then we're actually going to remove that equipment purchase and raw material purchase here. You can see if I go all the way up here, this should be adding back raw materials, which it is. You can see here, you don't want to add it twice, so you're adding it back in here, but actually taking it out when you think the cash is going out, which is right now we have it every 3 months. That all affects some net burn. So obviously the money you're going to need is your net burn plus any startup costs that you've got, and that all is dynamically calculated. I've done a really uh, interesting thing for cash distributions. Or I set this up, I believe, in the most dynamic and smart way you can. So it's going to look at your total requirement of equity, and then based on your total cash in, positive cash months and negative cash months is going to start reducing how much equity was available. And then these negative numbers here just mean that you had some negative months, but that was for your purchases, but you had a lot of positive months, so there's working capital there, which means you're not actually going to contribute more money. It's just you made some, you're building working capital, so some of that profit you've made is going to be reinvested into, those equipment purchases and mostly the raw material purchases. But when you add those together, you can see the actual cash that's available to distribute right here against the equity that was required to start. And this equity, no matter um, when it's used, is always put in the first year 0. And then we've got IRR calculations, which is internal rate of return for this whole thing, discounted cash flow analysis, and then we actually show that as well for the investor and owner operator based on their share of the cash flows. And you can see all this ties out, so this plus this will always equal this all the way over. And also you can see some checks here. This total cash in and out, this 61,821 will always equal this 61,821. And then if you just do cash in and don't count the equity that happened, you get to 67 million, which would be this number here, 67,315, so same. And this logic is really important because of possible cash flows in the future that are negative. that you don't want to double count as cash coming in. So this is well, there's a million ways to do it, but this is the way I thought was based on how everything else is set up. This is the best way to show possible distributions and contributions. We got a nice chart over here. Then I did an executive summary. It just shows high-level items, so revenues, cost of goods sold, G&A, S&M, R&D. Um, Now the G&A here is actually adding in the waste. On top of the G&A, it's adding in the waste, and because we're not adding that in, let's see, double check. No, yeah, that's just this. So we have to count for the payroll taxes, benefits, and um, Unis waste. So those are added into our executive summary G&A calculation. The other payroll taxes are already included in the cost of goods sold. That's just filled in here based on we've already done the calculation the monthly and rolled that into an annual. You've got your total expenses, EBITDA, which all this should match on the based on the annual and monthly. Your EBIT, debt service coverage ratio, annual EBIT per unit produced. So this is saying every unit you produce is making this much money. Debt service, principal balance owed, earnings before taxes, net earnings after tax, then all your other cash items. So this is just a nice clean way to sum up what's happening on the annual summary and without having to scroll through all of this, but it's still important to have all this information so you can back into the calculations and see how things are working. So this is the roll up. You've got some summaries here for the project, investor, and owner, operator. Break even month. So this is when you're covering the equity that was with the cash flows that were available. So month 23, year 2. Uh, Then I put a bunch of visuals. So total units produced, total revenue, gross profit, margin, gross profit, dollar amount, EBIT per year, average EBIT per unit produced, average cost per unit in aggregate, average cost per unit by the type, total units produced per year by type, cash flow before equity, cumulative cash flow, working capital. So this, like I said, we solved for this to be 0, so it'll never go below 0. But let's say you put in the other startup cost reserve of 500,000. What that means is when you actually see this hit 0, you've still got 500,000 of reserve, or whatever amount you put in for reserve. That's where that would go, or that's what that means. You got cumulative cash flow before equity, so this is showing you there's your break-even month. Um, but this is showing that if you didn't have any money, how much would you need essentially to get going? So we're solving for this minimum value when we figure out how much equity is needed. You can see over time build up your net margin rate, and I think that's it. So this model I believe is worth a lot more than $75, but that's what I'm charging for it. One-time fee. If you want to purchase it, I'll send it to you. It's going to be posted up at let me get a clean document here, or web page. It's going to be at smarthelping.com as well as Eloquence and efinancialmodels.com. If you want to buy it, the description in the link below, go to smarthelping.com, and then I just want to show you this is going to load up. Okay, so Google Chrome doesn't want to, oh, there we go. I also want to show you some updates. So on smarthelping.com, I've done some category adjustments. So the model I just talked about is going to show up right here. It's also going to show up under industry specific models under intermediate level. And I wanted to remind everybody I've done the buy by category, so you can buy things by category now. Instead of just before I had it where you can buy, 5 mid-level, 10 mid-level for that price, all mid-levels, all intermediate, all upper tier, all models and templates. But you might only want a certain couple in a certain category, but they might be some upper tier, some mid-level. So now I've done it so you can also buy by category. So hopefully that helps. Also, If you didn't know, there is a three-statement financial model that basically fits any model on this site where you just drop in the income statement and it'll fill in the monthly and annual income statement, balance sheet, and cash flow statement. And it's pretty robust, so you can also check that out. All right, well, that's all I got for you. I will see you guys on the next one.